Hi, welcome to Market in a Minute. The Chiefs and Eagles. That's going to be fun. Man, I tell you, the Eagles look really strong. I think it's going to be a really good game. The Chiefs have so much talent. You wake up in the morning not expecting the whole world turned upside down from a little startup company from China that create a better AI product than all this tens of billions of dollars that were sunk into creating this in the United States. So we're going to talk about DeepSeek a little bit and what that means for the tech group and what that means for the overall market. It's interesting. The technology sector is now down on the year, and then other sectors of the market, they're up really nicely on the year. So it's turning out to be the rotation we've been talking about is turning out to happen. So how it plays out from here will be kind of interesting. We think that the technicals are going to drive things, so we're going to walk through kind of our thought process on everything. The market update. So the DeepSeek technology is an open-ended, an open technology platform, which means, what does that mean? It means it's not proprietary, it's cheap. So that's what software developers love. So this could be a real win for the consumer, companies, and could really shine a light on how mismanaged this spending has been in the technology sectors. We're not totally comfortable with that statement. I think there needs to be a lot more investigation of what DeepSeek actually has, but it certainly seems interesting, and some of the technology leaders out there certainly see this as a real product. So we included a YouTube video that talks about what's going on with DeepSeek and some of the technology leaders, some of their opinions. At this point, we don't have enough information, so I feel like we're kind of just watching. We're not really invested in a lot of these companies. The tech group is not really interesting to us because we think that the technology sector, is so overowned. It's roughly 50% technology and related of the S&P 500. That is massively over what it has been historically. Usually it's around 20 to as much as 30%, but certainly not 50%. So maybe the real issue was not this DeepSeek coming out with a better idea. It's just that the overvaluation and just the belief that NVIDIA is the best thing that ever happened, just because the stock went up quite a bit. So we see this all the time. I've seen this all the time in my roughly 40-year career now, that the leaders can be displaced fairly easily over time. And so the life cycle of a technology company can be pretty short. So, NVIDIA certainly displaced Intel very quickly. Intel had a leading position for multiple decades, but NVIDIA has replaced Intel. Maybe somebody else is replacing NVIDIA at this point. It would be very quick to happen, wouldn't it? So what does all this mean? It means that these massive data centers potentially don't need to be built. You don't need such massive data centers if you don't need the power that's needed and you have a cheaper way of doing it. So it's kind of interesting. Less energy, less spending. It certainly is a win for non-technology investors that get this technology cheaply. So the focus this week's going to be on Microsoft and Meta, their earnings reports this week on Wednesday. So investors are going to want to hammer this thoroughly. And so it'll be interesting to see how these companies meander through this. So you can go on their websites, both websites, and sign up for the conference calls and listen in. So I kind of wonder, is this announcement from China, is this a kind of get back at you for TikTok? I don't know. Kind of thinking about that a little bit. But we see if this is a real deal, how this plays out. This could rotate. The money could rotate so severely out of tech, and it could cause a bear market, or it just could cause a nice rotation into the other groups. Without question, in my mind, okay, that the rotation is on, and it's going to be driven by this massive overinvestment in technology in terms of PE multiples and multiples times revenues. There's too much money over there, and it's got to come back to the middle a little bit. So the Trump policies certainly give a catalyst to get that rotation to occur. So our big issue with all this has with the markets have been the yield on the 10-year Treasury moved up to 4.8. Now it's back down to roughly 4.5. At 4.8, then you start thinking, okay, it's going to go over 5. Where over 5 does that really matter? So our analysis says at 5.5, and maybe as high as 6, you get a similar reaction in the markets as you would get like we got in 1987, a really big, quick, ugly bear market that could happen. So at this point, that's not our fear. Our fear is the mass overvaluation of technology and what happens in the market with the tech sector being so highly valued and maybe a potentially better way of doing all this coming around. So this is kind of a really interesting point in the markets. We were doing some work over the weekend on all the sectors, but the group that really just stood out, and it's all valuation driven, was the consumer staples sector. All those food stocks and stocks like Pepsi, but all those food stocks look really, really cheap. Hershey's and General Mills, and there's probably a good 15 of them that look like very viable stocks. As the markets rotate back and forth, this sector will come back into play, and it certainly had a big day on Monday with the technology sector falling. That just shows you the valuation in the group and that this is a safe place to rotate to. So we're looking for a rotation. We really thought that it would be more clear about the rotation in the middle part of 2026, or excuse me, in the middle part of 2025, when they start to look at 2026 capital spending budgets. So if you look at, in the middle part of 2025, we thought, okay, you're looking out to 26, those budgets for spending on AI were going to be maybe flat. Now we're pretty comfortable in thinking they're probably going to be down. So I don't think investors are going to want to have these companies put more and more spending into AI, knowing there might be a lot cheaper way of doing all this. So there's a cloud over technology currently. And again, we'll have to see how this plays out. And the next catalyst points are the earnings to be reported on Wednesday. And then you have more earnings next week as well. Before I talk about Veru, I just want to point the graph on technology. So the technology sector was down 4.9% on Monday. That's a big drop, drop of nearly 5%. It blew right through the 50 and the 20 and went down to roughly the 100-day or maybe slightly below the 100-day moving averages. So that was a big hit. Usually hits like that, usually they continue for a while. So we'll have to see if it continues and if it could hold the 200-day moving average. Now, there's going to be a lot of people pushing the technology sectors, a lot of diehard bulls that are only bulls that never see the negative side of things. They're going to be coming out and pounding the table on this sector. So we'll have to see if it rallies much at all. And then on the technicals for the S&P 500, okay, so we've been watching this top forming here and felt like, okay, maybe the top is no longer going to occur. And then the tech sector blew up. So it's back down, the S&P's back down right at the 50-day moving average. We like the 50-day. We think the 50-day is a very important moving average. So just to give you some idea of how we manage money. Our loss averse and our tactical strategies use inverse ETFs on indexes like the S&P 500 to protect the downside. We hate losing money, right? So we use these to keep the portfolio intact and to protect the portfolio as the market, or if the market would roll over into a bear market. A lot of times it's just wasted insurance, but when things start to really come apart, you can have a 20 or 30 or 40% decline in the overall markets. Those inverse ETFs work really well on protecting the downside. Just as a side note, next week we're going to talk about how to put together a durable portfolio. So no hedges in place, but a durable portfolio that could have some offsets. If one group's going up and or down, another group might be going up, but have a nice dividend yield to that portfolio where you don't really have to worry too much about a bear market. There'll be some wiggle in the portfolio, but not too concerned about a bear market. So we're going to walk through that portfolio and we're going to put it together online. Now, so we're watching the S&P 500 if it would break the 50-day to get more defensive and see how far that goes down if it does break it, and then look for a point to come back on the positive side. Sometimes it takes months for these sort of corrections to play out, and these inverses really help a lot. Now, for you, okay, I don't get why the stock was down 47% on the report of their phase 2B data. I don't know what the market was thinking. It's bizarre, and you're going to see a lot of people come out, pound the table on this as a buy. So the phase 2B data, I'm going to walk you through this. So the phase 2B data was their drug and Wegovy put together. So Wegovy is the Novo Nordisk drug, GLP-1 for weight loss. So what occurred? So the VERU is there to preserve the muscle mass, right? So over a 16-week period, on Wegovy and the drug, the patients saw in this study a 1.2% loss in muscle mass. So that's not bad compared to Wegovy plus placebo. So nothing, just Wegovy is what it was. So that saw a 4.1% loss in lean muscle mass. So only on Wegovy, there was a 71% benefit by using the drug, 71% benefit to lean muscle mass. Additionally, okay, catch this. Additionally, patients on Wegovy and the VERU drug lost a combined 27% more fat than just being on Wegovy alone. So that's pretty significant. That's really kind of, those are really good data points. They're moving into phase 3, and I really like this stock. I think it's really cheap. It's for whatever reason, saw a lot of selling on the news. I expected some selling on the news. I didn't expect the stock to race away necessarily, as it was up quite a bit prior to the data coming out, but I didn't expect much of a decline either. So down in where it is below 70 cents, I bought more stock for myself personally. So I think it's a really interesting point to be buying this stock. You should do your own homework on it. These biotechnology stocks tend to be very volatile. They're risky. Even with good numbers, you could have a lot of volatility and lose money. So make sure if you buy stocks like this that you weight them properly in a portfolio. So most investors, around a 1% or 2% position is appropriate. We like this company. Now, remember the data points on Wednesday, Microsoft and Meta for the tech group. We like VERU. We like some other other stocks in the biotechnology sector as well. We think the rotation's in place. We want to be a little conservative in here. If the market's going to roll over and correct or go into a bear market based on what's happening in the tech sector, we want to protect ourselves. So please hit like, come to my website, Patrick Adams CFA, subscribe to Mark in a Minute, get a hard copy of it. For whatever reason you subscribe and don't get it, just re-email us again. And if you ever have any questions, please ping me. And if you want to, after the video next week, if you want to talk about that portfolio, we think it's a really strong portfolio for the long term for a moderate investor. Take care.